In January 1962, on a morning that at first glance seemed no different from any other for a lawyer juggling family responsibilities and constant financial worries, I made a decision that later became a monumental turning point in my entire economic life. At the time, I put down exactly $1,000, a sum that was by no means trivial given my circumstances, to purchase a tiny, overlooked oil royalty interest that most people considered worthless or too complicated to bother with. Yet that very investment, which almost everyone around me dismissed as quirky or unsuitable for an ordinary person, turned into the financial stream that sustained me for the next 62 years. It consistently paid me $70,000 to $100,000 per year, not through luck, but thanks to the enduring nature of cash flow, the structure of the contract, and a series of right decisions built on deep understanding and zero haste. As of today, the total income I've received from that single investment has exceeded $6 million, and the most astonishing part is that it's still generating income for me as I sit here at age 99 recounting the whole story to you. I'm Charlie Munger, and while my life has seen countless deals big and small, investments that produce billions of dollars, that modest $1,000 outlay still holds an extraordinarily special meaning, not because of the profit figure, though of course it's impressive, but because it taught me the core lessons about the nature of money, how real opportunities emerge, the importance of deep knowledge, and the right mindset an investor needs when facing things the crowd routinely ignores or misjudges. I'm telling you this story not to brag, but to illustrate in a vivid way that sometimes a single right decision, grounded in diligent research, patience, and independent thinking, can produce effects that last a lifetime. But before I take you into the details of the deal that changed my life, I need to issue a blunt warning. What I'm about to share will contradict almost everything in the conventional financial advice you've ever heard. It won't resemble the lessons crammed into textbooks. It won't echo the slogans the financial services industry repeats like gospel, and it certainly won't match what TV analysts say about the markets. I'm not here to tell you what sounds pleasant. I'm 99 years old. I've lived through every market cycle imaginable. I've seen thousands get rich and thousands go bust, and I have no reason left to say things that are safe or easy on the ears. Real lessons are usually rough, counterintuitive, and require the listener to set aside some stubbornness in their conventional thinking. So if you're expecting me to say invest in what's trendy, follow the crowd, listen to the experts on TV, or chase hot trends, let me tell you right now, you'll be disappointed. But if you truly want to understand the essence of building wealth, not the get-rich-quick kind, but the sustainable, reliable kind that isn't dictated by fate or the market, then my story will help you see things most people don't see, or see but don't understand, or understand but lack the patience to act on. I want you to fully grasp my situation at that moment, because context is what makes numbers and decisions meaningful. I was 38, fresh off an emotionally draining divorce, worrying about 3 young kids and alimony payments that weren't easy, while my law practice income, around $40,000 a year, was decent for the era, but nowhere near enough to give me long-term peace of mind. I saved rigorously, avoided extravagance, always tried to do what was right by standard advice, that a responsible man must accumulate, be cautious, think ahead. But even doing everything deemed correct, I still felt like I wasn't truly advancing. Savings grew painfully slowly, while inflation quietly eroded the purchasing power of every dollar. Around that time, my friends and colleagues were doing what society then considered standard investing, buying stocks on tips, whispered by brokers, putting money into mutual funds without ever reading the prospectus, or snapping up real estate with big mortgages just because everyone was doing it. I watched them for years and realized one hard-to-swallow truth. Most weren't really moving forward financially. They might make a little on one deal, then lose it on another. Overall, they were treading water. What puzzled me wasn't that they lost money, but that I couldn't find any consistent pattern of success or failure. It all seemed like a series of random events, a game where players hoped luck was on their side, and I don't believe life should run like a gamble. Then, one day, my friend Jake, a geologist I'd known since college, a guy with an almost fanatical passion for what he did, walked into my office. Jake was the rare type. He didn't just know geology, he lived it, thought about it every waking hour, and crucially, he understood how cash flowed in the oil business, something many technically skilled geologists ignore because they lack business sense. He came in, spread a geological survey map on my desk, pointed to it, and said something I've never forgotten. "Charlie, I've been studying this field for 6 months, and there's an opportunity here nobody's paying attention to." And that's where the story begins. Jake started explaining a cascade of details that were obvious to him, but completely foreign to a lawyer like me back then. Contour lines showing the mushroom-shaped reservoir structure, differential pressure zones underground, the production history of every well in the Wilmington field, and subtle hints about flow quality he read from dense geological data that a layperson would dismiss as meaningless scribbles. I listened, trying to keep up with his reasoning. Even though 80% of what he said initially sailed over my head, one thing kept my eyes glued to the map: the calm, unpretentious certainty in Jake's voice, the kind that only comes when someone truly knows their subject inside out. But the key wasn't the technical geology, it was the sentence he dropped right after. "These wells have produced steadily for 30 years. The decline curve is extremely gentle and totally predictable. The reservoir has excellent pressure characteristics, indicating decades more production. And there's a small royalty interest for sale, but nobody's touching it because it's too tiny for big companies and too complicated for individual investors." That was the moment I clearly sensed something. This wasn't just an asset, it was a market blind spot, a minuscule piece that most people couldn't see the value in, yet could hold massive value for someone who did. And from my legal career, I'd learned that blind spots like that are often where real opportunities live. Jake said the current owner was an elderly widow whose husband had been in the oil business over half a century ago. She didn't grasp the true value of this royalty. Understandably, it was both too technical and too small for anyone to bother advising her properly. She just wanted to sell to tidy up her estate, and she was asking $2,500. At the time, I had about $8,000 in savings, but I knew I couldn't risk nearly all of it on a deal I'd only heard about for 30 minutes. I told Jake I was only willing to put in $1,000 and asked if that would even work. He didn't hesitate, just said something I've remembered ever since. "Charlie, if you can get it for $1,000, buy it immediately. It's worth at least $10,000 if you look at it right." Still, I've never been the type to jump just because someone tells me to. I thanked Jake, folded up the map, and said I needed time to think. But that night I couldn't sleep. What he'd said, what I'd seen on the map, and especially the idea of an asset nobody was paying attention to, kept looping in my mind. I've always believed big opportunities hide where others don't bother looking, and this time every sign pointed that way. But I also knew myself. I never put money into anything I didn't understand. So the next morning I called Jake and said, if I was going to take this seriously, I needed to see everything. Not a summary, but all the geological reports, well logs, production history, legal contracts, everything tied to this royalty. Jake agreed instantly and dropped off a stack of documents nearly 6 inches thick. From that point, I embarked on one of the most grueling yet transformative work stretches of my life. For 3 straight weeks, every evening from 7 p.m. to midnight, plus full weekends, I sat at my desk slowly reading every page, taking notes on anything I thought might matter. I didn't know much geology, but I knew analysis, and I knew how to ask the right questions. I looked up books, called advisors, even met with an oil engineer Jake introduced to clarify murky points in the files. Most people wouldn't spend more than 3 hours on a few $1,000 deal. I spent 3 weeks, and that serious effort was why I could see things any casual skim would miss. The consistency of production over time, the rare reservoir characteristics, the pristine record keeping, the value in the royalty contract structure, near zero legal risk, and, most importantly, the glaring gap between intrinsic value and the widow's asking price. In the process, I realized something that later became one of my biggest investing lessons. Most investors don't lose because they're dumb, but because they're lazy. Lazy to dig deep, lazy to ask questions, lazy to verify facts, lazy to think independently. They want a quick answer, Simple advice, a clear signal from outside. But real investing never works that easily. Truly good assets always demand mental labor, reading, questioning, patience to piece together scattered information into a complete picture. By week 3, I saw that picture as clear as daylight. Geologically, 3 decades of well output and a near linear decline rate showed the reservoir was still abundant. Legally, the documents were so clean it was almost impossible to find a loophole that could spark a dispute. Financially, current cash flow plus conservative assumptions all pointed to one conclusion. The royalty was worth far more than the $2,500 the widow wanted, and certainly more than the $1,000 I planned to offer. Yet I was still stuck with my personal finance math. I only wanted, and could only afford, to invest $1,000. After many sleepless nights, I decided to do something not everyone would dare. I wrote an honest letter to the widow. I explained I understood what she was selling. I wasn't trying to take advantage of her lack of knowledge, but my finances only allowed $1,000. I offered cash, fast closing, no extra demands, no complicated contingencies. I made clear I could wrap it up in a week if she agreed. 2 days later, she called. I still remember her voice on the phone, and said yes. She'd been trying to sell this royalty for over 3 years with no takers. It was too small for big firms and too complex for retail investors. She just wanted it resolved and felt relieved to find someone who actually understood its worth. We signed papers on a Friday afternoon. Monday morning I wired the $1,000, and from that moment I owned a 1/16 royalty interest in 17 producing oil wells in the Wilmington field. I'd put nearly 1/8 of my savings into something most friends called nonsense. But as you'll see in the next part, that decision changed everything. After wiring the $1,000 and finalizing all legal paperwork, I officially became the owner of a tiny royalty interest in 17 producing oil wells in the Wilmington field. And though it was just a simple transaction, it marked the start of a journey I later realized didn't just change my bank account, it changed how I viewed investing, luck, effort, and patience. Back then, I felt no eureka excitement, no illusion I was about to get rich, just a plain, clear sense that I'd done my rational homework, researched deeply enough, weighed risks carefully enough, and now it was time to watch reality play out. The first 6 months passed in near tedious silence, if you're someone craving a breakout. I saw no financial miracle. The wells kept pumping steadily, the operating company sent monthly production reports, and each month I got a small check, $87 the first month, about $92 a second, $116 another. Over the year I pulled in $1,000 to $1,200, a 10 to 12% yield on my $1,000. To someone impatient to double their money in months, that's nothing exciting. But to someone who trusted substantive analysis, sustainable cash flow, and the discipline of time, those little checks were the first bricks in a house I knew I could build for decades. My friends, mostly lawyers or finance types, obsessed with whatever was hot in the markets. When I mentioned investing in an oil royalty, looked at me like I'd signed up for some bizarre game of chance. Where's the big profit? When are you selling? Why tie up money in something nobody understands? What they didn't get, or refused to get, was that not every asset is judged by quick price appreciation. Some are judged by their ability to deliver steady cash, stability, independence from market psychology, and letting you sleep at night. I studied those monthly checks not for their size, but for what they taught me about how oil works as an industry. Output might decline gently over time, but at a highly predictable rate. Extraction costs didn't spike, and oil prices, the one factor outside my control, though volatile with markets, trended upward as global demand grew. Month by month I learned a bit more. Year by year I grew more confident in my original analysis. Within 5 years, everything I'd projected unfolded even better than expected. As the U.S. economy boomed in the 1960s, global crude demand soared, pushing oil prices up while extraction costs stayed flat. That meant the same well output, but far more money flowing to me, from a few dozen dollars a month to $150 and then $250, just from higher prices. I did nothing extra, made no new decisions, no stressful calculations. I simply benefited from the natural mechanics of an industry I'd entered at the right moment. At the same time, I learned tax nuances I'd missed before, specifically the depletion allowance. a tax break unique to income from natural resource extraction. In simple terms, the government lets royalty owners deduct a portion of income as if the asset were gradually depleting, keeping more after-tax cash. When I grasped this, I almost laughed out loud with delight. Not only had I bought a stable cash flow asset, I'd stumbled into one with powerful tax preference. You can't see that just from the purchase price. You only get it by digging. Meanwhile, people around me kept chasing hyped stocks, explosive growth stories, opportunities everyone was talking about. Nothing wrong with that, but I also saw they were always anxious, glued to daily market moves, chasing signals they didn't truly understand. My little royalty, on the other hand, kept paying without caring whether stocks rose or fell, what the Fed did, or how other investors panicked. That total detachment from market emotion and volatility taught me one of the greatest lessons of my investing life. Some assets don't need you to hope or predict. They just need time to do their job. And steady, reliable cash flow, especially when reinvested into other opportunities, is what builds lasting wealth, not instant price pops everyone gets sucked into. By 1970, 8 years after putting in $1,000, I'd received about $18,000 in royalties. That meant I'd recovered my capital 18 times over, and I still own the cash flow machine. The wells showed no signs of drying up, and decline stayed on the curve I'd modeled initially. You have to grasp this clearly. When you own an asset whose long-term cash flow is proven by real-world performance over years, you gain a certainty no market can take away. It's not, hope it goes up. It's, I know it will keep paying because the data has proven it for years. That certainty made the investment extraordinary. It didn't drive me crazy, didn't keep me up at night. It just paid, year after year. From 1970 onward, cash flow kept growing, sometimes slowly, sometimes faster, all tied to oil prices, output, and external factors I didn't need to control. I only needed one thing, patience. And patience is what most investors lack most. But the story doesn't end there. And in the next part, I'll tell you how that tiny royalty kept compounding beyond imagination, especially as the world entered eras of massive energy volatility and oil extraction tech advances. Through the 1970s and into the 1980s, the $1,000 royalty kept delivering cash flow that was not only steady but growing in ways that, I'll admit, exceeded even my cautious initial forecasts. As the world faced huge oil price shocks, from the 1973 embargo to the late decade energy crisis, many investors panicked, industries staggered, but my royalty sat in a strange, almost paradoxical sweet spot. The higher oil went, the more cash flowed in, with no meaningful production drop to offset it. That meant while stock markets endured brutal corrections and portfolios got shredded, my boring investment nobody ever valued properly just kept chugging along, quietly, relentlessly, compounding in the most reliable way imaginable. By 1980, I'd received around $45,000 from the original stake, and I remember the feeling vividly, not lottery-style elation or big score thrill, but a slow, satisfying contentment, like watching a seed you carefully planted years ago grow into a sturdy tree, no fanfare but solid and alive. It deepened my favorite line. The big money isn't in the buying or the selling, it's in the waiting. You can't wait if you don't know what you own, but once you know it to the core, waiting becomes easy. Into the 1990s, amid the Gulf War, geopolitical swings, and major energy industry shifts, cash from my royalty kept hitting my account almost uninterrupted. By 1990, the cumulative total was about $90,000. Just look at that number, and you'll get what I mean when I stress that long-term, stable cash flow usually beats short-term price volatility. People love bragging about 2x, 4x, 10x in 2 years, but they miss the power of 90x in 30 years without chasing market mania. Entering the 2000s, oil extraction tech improved, horizontal drilling, enhanced recovery methods. That breathed new efficiency into wells once seen as old. Not every one of my 17 got the upgrade, but even partial gains kept cash flow higher than anyone expected. By 2000, I'd received roughly $150,000 total from the $1,000, and I knew that was still peanuts compared to what was coming. One of the most memorable moments came in the early 2000s, when a major oil company approached me offering $300,000 cash to buy the entire royalty. The number sounded tempting to many, but a quick mental calc told me it was laughably low. They wanted to pay $300,000 while I was pulling in about $75,000 a year then. That's a multiple any business would call a gentle robbery. Why sell a proven decades-long money printer for just 3 or 4 years' income? I turned them down flat, and I've never regretted it. Short-term thinkers sell cash flow assets too early for instant profit, then scramble back into the market anxious and hunting. I didn't want to play that game again. I had an asset proven durable, market independent, and capable of paying for life. When you find a goose laying golden eggs, you don't sell it for 3 eggs up front. From 2010 to 2022, the energy world faced unprecedented change. U.S. fracking boom, clean energy push, wild oil price swings, intense geopolitics, even a global pandemic. Yet the Wilmington wells kept producing. Royalty checks kept arriving. Some years $50,000, some over $100,000, averaging $70,000, $80,000. Just 2010-2022 added nearly $1 million. Add it all up, nearly 6 decades of cash from a $1,000 seed, and exceeding $6 million isn't a legend. It's the logical outcome of understanding the asset, paying the right price, and waiting long enough. What always makes me think is, if most investors grasp the importance of finding real cash flow assets and embrace long-term thinking, we'd have far fewer people stressed about money. But most don't, not because they can't, but because they won't wait, won't dig, won't differ from the crowd. I did the opposite. I didn't care about looking smart to others. I cared about analyzing right and acting when odds clearly favored me. In the next part, I'll tell you the most important thing, why the principles behind that $1,000 oil royalty apply to countless opportunities today, and how you can find your own version without knowing a thing about oil. Looking back on the whole journey with that tiny oil royalty, I realized what truly made the difference wasn't the asset itself, wasn't oil, wasn't geology, not even historical context or luck. The critical factor, and what most people overlook, is the principles behind the investment decision, principles that were true for oil in 1962 and remain true for any asset, any market cycle, any generation of investor. Understood properly, you'll see they can be applied right now, even if you know nothing about oil, have no geologist friends, and don't live in an era when odd assets like royalties were laughably underpriced. The first principle that investment taught me, and maybe the most important of my entire investing life, is hunt for opportunities where the crowd isn't looking. The crowd always migrates to bright lights, noise, media hype, experts touting big opportunities and new trends, tech breakthroughs. But investing truth lies in the opposite. The best opportunities aren't on stage but backstage, not loud but quiet, not where everyone fights but where nobody bothers to pick up what's lying there. Remember, the 1962 royalty I bought was completely forgotten. Big oil firms ignored it because it was too small to move their financials. Retail investors ignored it because it was too complex to parse. And that gap, between two groups that wouldn't touch it, created a dazzling opening for the one person willing to work. Where the crowd doesn't look, value is often underpriced. Where nobody cares, advantage hides. Where there's no competition, real gold usually sits. The second principle, only invest when you understand deeply. And deeply doesn't mean reading one article, watching a video, or hearing a friend mention it. Deep means you can explain the asset like you designed it. You can analyze risks from multiple angles. You can model its cash flow short, medium, and long term. And you know exactly what could kill it. I know plenty who think they understand an investment from surface skimming, but surface understanding is why they panic when markets shake and why they dump good assets out of short-term fear. My 3 straight weeks of study gave me a certainty no market swing could erode. When you know an asset better than the seller, when you know precisely what you're buying, why it's valuable, why the asking price is below intrinsic value, you gain an edge most investors lack: internal conviction. That's a belief needing no external validation, unshaken by news, unmoved by market mood. People with internal conviction can wait. People without deep knowledge always rush. The third principle, which I believe is one of investing's greatest secrets: Cash flow matters more than price appreciation. Most approach markets with a buy low, sell high mindset. But that's speculation, not investing. Real investing is buying an asset you know will produce cash, steady, sustainable, and capable of growing over time. When you invest for cash flow, you don't need to predict markets, nail timing, or sell to realize gains. You profit monthly, quarterly, yearly, and it compounds. My oil royalty never required me to find a greater fool. It paid whether markets rose or fell, whether the economy expanded or contracted, whether I paid attention or not. That's the hallmark of a great asset. The fourth principle, price and value are always different, and the investor's job isn't to forecast price, but to recognize value. The widow wanted $2,500. I paid $1,000. But the intrinsic value I calculated was $10,000 to $15,000, extremely conservative. That gap wasn't market chaos. It was lack of competition, lack of digging, lack of understanding. Markets aren't always stupid, but they're often lazy, and the crowd's laziness is the diligent person's edge. The fifth, and perhaps greatest principle, time is the knowledgeable investor's best friend. I held that investment not 5 years, not 10, but over 60. Across 6 decades, I never panic sold, never ditched it on short-term wobbles, never second-guessed my original analysis. The crowd views markets through a short lens, 3 months, 6 months, a year. I viewed in decades. That's why I got returns tens, even hundreds of times my capital. When you let time work for you, let cash flow accumulate and compound interest run full cycle, you witness what Einstein called the eighth wonder of the world. But if I just talk theory, you might think this only applied to my era. So in the next part, I'll spell out specific, real opportunities existing right now that you can find and apply the exact principles above, whether it's 2024 or any other year. Those opportunities aren't in glamorous industries, not on growth stock leaderboards, but in overlooked corners with massively underpriced value. And here's where I want you to really pay attention, because from this point, the story stops being about what I did in 1962 and starts being about what you can do in your own era. When the world has changed, oil isn't the simple play it once was. And tech, data, information move faster than anyone ever dreamed. Yet no matter how profoundly the investing landscape has shifted, the principles I distilled from that $1,000 royalty remain unchanged. They retain full power, and applied to the right context, they can produce investments as enduring, maybe even more so, than mine. Understand this clearly. Opportunities never vanish. They just migrate from place to place, industry to industry, from those who see to those who don't. One generation misses, the next discovers. The only question is who's willing to work to understand and who prefers the easy path, then blames circumstances. My era had oil. Yours has other things, but the essence is identical. So what are the modern oil royalties? Start simple. Small cash flow businesses. Across America, millions of baby boomer-owned companies face succession crises. They've run 20, 30 years, rock-solid stability, loyal customers, great cash flow, but the owner is old, wants to retire, no kids to take over, and buyers are scarce. Most operate in boring sectors: plumbing, HVAC, small construction, industrial cleaning, equipment distribution, local trucking, mid-sized logistics, hyper-niche retail. Nobody writes glowing articles, nobody puts them on TV, nobody chats about them on trendy forums. And that's exactly why they're priced absurdly low. I've seen countless such businesses sell for 3 to 5 times cash flow, while public companies trade at 12 to 20 times earnings. By one generating $250,000 annual cash for $900,000 to $1.2 million, and run it decently, and you own a modern royalty. It pays monthly, doesn't need you to predict markets, doesn't care where the S&P goes, and can support you for life. Why do people ignore them? Because they're boring. Because they require real understanding, on-site visits, customer meetings, financial statement review, not just chart gazing. And because everyone prefers talking AI, biotech, crypto over HVAC or plumbing. But markets don't pay for glamour. They pay for cash flow. Second modern opportunity: orphan stocks, small companies, steady profits, low debt, strong cash flow, but zero analyst coverage, Zero buzz because they lack a sexy story. They're not tech firms growing revenue 50% yearly. They're off big funds' radar due to tiny market cap. Day traders hate them for low volatility. But that silence is your edge. I've seen many trade at single-digit PEs, rare in any efficient market, simply because nobody bothers researching. Spend time on financials, profit history, industry dynamics, management quality, and you can find assets 50 to 70% below intrinsic value, just like I did in 1962. Third, and one of the clearest royalty types, is intellectual property ownership. Book rights, music catalogs, patents, software licenses, small trademarks, even digital content rights on modern platforms. In the digital economy, intangibles generate more cash than ever. Buy rights to a modest IP with steady licensing, royalty, or digital distribution revenue, and you own cash flow indistinguishable from oil royalties. No operations, no manufacturing, no staff management, just monitor cash and protect ownership. Fourth, cash flow, real estate, and secondary and tertiary markets where prices are sane. Cap rates still deliver 8 to 10% after costs, and you're not competing with speculators chasing short-term flips. In those markets, you can buy rentals far cheaper than in big cities, and holding 15 to 25 years lets cash flow rise with inflation, tenants pay down debt, and asset value grows organically. Each rental becomes a mini royalty you can touch. See, none of the opportunities I listed involve oil. They need no exotic skills, no PhD level knowledge, no crystal ball. They only require one thing: willingness to do work most people refuse. Willingness to read, learn, persist. Study the mundane, resist shiny trends. Truth is, opportunities aren't scarce. What's scarce is people willing to seize them the right way. Do what the crowd does and you'll get crowd results. But apply the principles. Hunt where few search. Understand deeply, not superficially. Focus on cash flow. Distinguish price from value. Stay patient with time. And you stand a strong chance of finding your own oil royalty in this era. In the final part, I'll tell you the most crucial thing: why so few people succeed despite everything being within reach, and what truly decides whether you become the finder or just the listener of someone else's story. And now, having walked the entire journey with me from my 1962 personal context to the seemingly tiny $1,000 decision that paid for over 6 decades, to the 5 bedrock principles applicable to any market, I want to state the most important point, probably the one most seeking financial advice never truly want to hear. Every great opportunity in life is achievable, but not everyone is willing to pay the price to seize it. The price I mean isn't money, it's far harder. Patience, discipline, diligence, and above all, the ability to think independently, to stand apart from the crowd when necessary. These aren't innate gifts, they're choices, but most people don't choose them, and thus disqualify themselves from opportunities they could objectively grab. Think back to my oil royalty story. What really let me find it? Not magical talent, random luck, or superhuman wisdom. I found it only because I did something almost nobody else would. Sit down and study a boring stack of papers for 3 straight weeks. Ask yourself, in today's world, how many are willing to do that for a $1,000 opportunity? Answer: virtually none. And that none creates the edge for the one who will. Another thing I learned and want to hammer home is most people invest for emotional payoff, not profit. They crave excitement, the feeling of being part of something big, bragging rights about owning the latest tech or hot sector. They want social validation that they're smart, quick with it. But investing isn't entertainment or self-display. It's a calm, disciplined, even emotionless activity regarding surrounding chatter. What made my $1,000 investment a life story is it never required bragging. I couldn't take it to a dinner party and say, I'm invested in a royalty on 17 oil wells in Wilmington. Nobody would care. Some would laugh. But I didn't invest for attention. I invested for wealth, and wealth doesn't need spotlight to be real. No recognition needed. It's still printed money. Most investors fail not from lack of ability, but from refusing the boring path. The path of steady cash. The path of meticulous analysis. The path of patience across time. The 20, 30-year path instead of 6 or 12 months. They want extraordinary results, but fear ordinary work. They want assets, but skip process. They want riches, but won't wait. You see it clearly in how people today consume info and decide. They want speed, simplicity, someone to say, buy this stock, this coin's mooning, don't miss this. Rely on mass info, and you get mass results. Chase hype, and you exit when the bubble pops. Buy on emotion without understanding, and you panic when markets shift. Me? I didn't care what the market thought. I cared what my asset thought. A good asset's argument is crystal. I'll pay you every month, year after year. I'll keep running no matter what the market does. That's the anti-fragility I always seek. And you can find such assets, small businesses, real estate, orphan stocks, IP, if you look where others won't. Also know, most great investment opportunities don't feel comfortable when you decide. When I bought that royalty, most acquaintances thought I was nuts. Nobody said, great move, Charlie. Nobody cheered. Nobody envied. Nobody imagined it could yield millions long term. But that's the nature of good investing. It rarely gets applause up front, but it gets recognized after 10, 20, 30 years. You must be solid enough to endure initial loneliness. And when your conviction is rooted in deep knowledge, you need no external cheer. Time cheers for you. 62 years can't be faked. Cash flow doesn't lie. Numbers don't lie. Compound interest doesn't lie. Only human emotion lies. So if you want your own oil royalty, be ready to search where others won't, read what others skip, wait while others bail, understand deeply what others skim. That's why I often say, most people won't get rich not because they can't, but because they won't do what's required. You can be different simply by doing the work others dodge. My 1962 $1,000 has paid me over $6 million and still pays today. But it didn't just pay in dollars, it paid in lessons. Lessons that wealth doesn't come from flash luck, trend chasing, secrets, or magic formulas. Wealth comes from understanding, patience, and practicing simple but hard principles very few stick with. Apply them to your era, and I believe you'll find a life-changing investment. Maybe not an oil royalty, maybe not from Wilmington, but your own version that prints money for decades, simply because you did what the majority won't. Understand deeply, pay the right price, and patiently wait. And then you'll know why I always say, the right investing principles never change. Only people do.